Welcome to Tech Stocks Daily, your go-to source for the latest and greatest in technology stock news. Today, Google finds itself at the heart of tech talks with its controversial update that is stirring a pot of mixed reactions among Android users. This significant shift involves Google drawing parallels with Apple's ironclad controls over its ecosystem, a move that has historically set the two tech giants apart. Google has always been seen as the more open alternative to Apple's gated community. Android OS, known for its flexibility, has been the go-to for users who prefer a more customizable experience. However, recent developments indicate that Google is borrowing a leaf out of Apple's book, with an increased focus on AI upgrades, security measures against dangerous apps, and changes in the third-party App Store ecosystem. What's been particularly contentious is Google's decision to block Rich Communication Services, RCS, for rooted Android devices, a feature expected to bridge texting capabilities between Android and iPhone users later this year. The frustration among users is palpable on platforms like Reddit, where the consensus is that Google's move is not just a tightening of security, but an outright shadow ban on freedom of use. The crux of the matter lies in Google's attempt to control RCS messaging, essentially limiting how and who can send texts over its network. A Google spokesperson justified this approach as a measure against spam and abuse, emphasizing the need to ensure devices comply with RCS standards. Yet this explanation hasn't sufficed for many, with users expressing dismay over what they perceive as overreach and censorship by Google. This update, colloquially termed the Appleification of Google, signals a significant pivot in Google's philosophy, from being the champion of user choice and flexibility to adopting a more controlled, walled garden approach akin to that of Apple. While some understand the need for enhanced security and protection similar to those enjoyed by iPhone users, others view this move as a betrayal of the Android ethos. This entire scenario presents a complex web of advancements, user rights, and corporate control, leaving the Android community in a turmoil of adaptation and resistance. As Google tightens its grip, aiming to offer a safer, more streamlined experience, it risks alienating a portion of its user base that cherish the platform's open and malleable nature. In today's tech headline, Microsoft steals the spotlight, albeit for reasons that intertwine legal drama with the intricate dynamics of artificial intelligence, AI development. The buzz stems from a lawsuit filed by Elon Musk against OpenAI, the organization behind the revolutionary ChatGPT, and its CEO Sam Altman. Musk accuses the company of deviating from its foundational nonprofit ethos by entering a $13 billion partnership with Microsoft and opting to keep the source code of its newest AI products under wraps. Musk's affiliations with OpenAI date back to its inception in 2015, a venture he co-founded with lofty ambitions to mitigate the potential threats of artificial generative intelligence to humanity. Fast forward to today, and the landscape of OpenAI has dramatically transformed, particularly since Altman, along with other key figures, pivoted the organization towards a for-profit model within its structure by creating OpenAI LP in 2019. This monumental shift is at the heart of Musk's legal battle, asserting that such actions contravene the original charter of OpenAI, thus amounting to a breach of contract. Crucial to Musk's contention is Microsoft's influential role and economic stake within OpenAI, which, although not directly named as a defendant, is a recurring theme cited throughout the lawsuit. Musk articulates a narrative wherein OpenAI has morphed into a closed-source de facto subsidiary of Microsoft, set on refining AGI technologies primarily for Microsoft's pecuniary gain, rather than serving the broader interests of humanity as initially intended. The lawsuit caps off a tumultuous period for OpenAI, marked by leadership upheavals and Musk's continued vocal skepticism regarding the perils of unchecked AI development. While Musk categorizes the current leadership of OpenAI as driven by greed and profit, the matter ultimately raises profound questions about the stewardship of potentially world-altering technologies and the ethical ramifications of corporate influence over such powerful tools. Snowflake Inc., the leading cloud-based data warehousing company, made headlines today not for its technological innovations, but due to a significant hit it took in the stock market. On February 29, 2024, Snowflake's shares plunged by 18.1%, a sharp decline triggered by the company's announcement of lackluster earnings results and a less than promising future outlook, revealed after the market closed on February 28. The company reported quarterly earnings of 35 cents per share, surpassing the Zacks consensus estimate of 0.17 cents per share. While this indicates a stronger performance compared to the 14 cents per share from a year ago, Snowflake's forward-looking statements painted a drearier picture. Revenue forecasts fell short of expectations, and the disclosure of a rather disappointing projected product revenue growth for fiscal year 2025 further spooked investors. Specifically, the company anticipated first quarter product revenue to be between $745 million and $750 million, below the expected $759 million. Further complicating matters was the sudden departure of Snowflake's CEO, succeeded by the founder and CEO of Neeva, a company Snowflake had previously acquired. This leadership change added to the uncertainty surrounding the company's future direction and stability. In the wake of this news, major financial institutions adjusted their stance on Snowflake. UBS slashed its price target for the company's shares from $220 to $180, reflecting the gloomy revenue guidance, while Deutsche Bank reduced its share price target from $250 to $220. Despite these challenges, Snowflake's stumble may not be all doom and gloom for the broader investment landscape. The company's dip has influenced several ETFs, such as Spear Alpha ETF and TrueShares Technology, AI and Deep Learning ETF, among others, creating a potential opportunity for investors. These ETFs, which hold Snowflake shares, experienced a downturn as a result of the company's stock performance. However, savvy investors might see this as a prime moment to buy the dip and invest in these ETFs at a relatively lower price, gaining exposure to other high-potential technology companies in the process. Meta Platforms, the conglomerate behind the giant social media network Facebook, finds itself in a swirling controversy and making headlines today. The tech behemoth has taken a decisive step to halt payments to news publishers for sharing their content on Facebook in 3 significant markets: Australia, France, and Germany. This decision, announced on Wednesday, signifies a notable shift in Meta's strategy towards news content on its platforms, marking a departure from its previous practice of compensating news publishers for their contributions. This move by Meta is part of a broader trend by the company to reduce the emphasis on news and political content across its services. Reflecting this strategic realignment, Meta has also decided to discontinue its dedicated news tab feature in the UK, France, and Germany, areas that have previously enjoyed specialized treatment in Meta's ecosystem. The implications of Meta's decision are multifaceted, forecasting a looming confrontation with the Australian government, among others. The cessation of payments and Meta's reluctance to forge new commercial deals for traditional news content, coupled with its decision against launching new Facebook products for news publishers, marks a significant pivot in its approach to handling news content on its global platform. This recent development places Meta on a collision path with regulatory frameworks and government expectations, particularly in Australia, where regulations around digital platforms and their interactions with the news industry have been a point of contention. The fallout from this decision is yet to fully unfold, but anticipates a reconfiguration of relationships between major digital platforms and the news media industry in affected regions. Today's market sentiment is a tapestry of tension, transformation, and technological turmoil. At the center of today's discussions, Google's move to align Android's framework more closely with Apple's walled garden philosophy stands out, inducing a polarized reaction from its broad user base. This development represents a significant philosophical shift within the tech titan, hinting at an evolving landscape where control and security are increasingly prioritized, potentially at the expense of user freedom. On another front, Microsoft is embroiled in a high-profile lawsuit with Elon Musk, casting a shadow over its partnership with OpenAI. This legal battle accentuates the complexities of navigating AI's ethical and commercial domains, showcasing the growing pains of an industry at the very cusp of revolutionary changes. The suit not only underscores the contentious relationship between corporate ambition and foundational integrity, but also highlights the increasingly pivotal role of AI technology in shaping future business models and societal norms. Snowflake Inc. towards substantial market tumble today underscores the volatile nature of tech stocks, especially for companies navigating the choppy waters of high expectations and transforming market dynamics. Snowflake's downturn, prompted by disappointing financial forecasts and a CEO shuffle, serves as a stark reminder of the challenges facing cloud technology and data warehousing businesses in maintaining growth trajectories and investor confidence amidst intense competitive pressures. Meta Platforms' decision to cease paying for news content in key markets marks yet another chapter in the ongoing saga of tech giants clashing with governmental and regulatory bodies. Meta's stance speaks volumes about the shifting dynamics of content monetization and distribution, setting the stage for potential regulatory confrontations and a reevaluation of the symbiotic relationship between social media platforms and news organizations. In terms of Apple, references within today's narratives indirectly highlight the intricate interplay between innovation, competition, and market expectations. Apple's maneuvers, though not detailed in today's coverage, often serve as a barometer for market health and tech innovation trends, indirectly influencing the broader tech and financial ecosystems through its strategic decisions and market leadership. Overall, today's market sentiment is one of cautious anticipation as stakeholders across the tech and financial spectrums navigate the complex interplay of innovation, regulation, and evolving consumer expectations. These developments signal a transformative period for technology companies, wherein adaptation and strategic foresight will be key to navigating the uncertainties that lie ahead. As we wrap up this eventful week, the market's trajectory in the coming days appears to be at the mercy of several key factors, each with the potential to stir the brew of market sentiment in significant ways. Firstly, the ongoing saga between Elon Musk and Microsoft, particularly around AI and OpenAI's strategies, will likely continue to cast a long shadow over the market. Given AI's central role in the next wave of technological innovations, any developments, legal or otherwise, could sway market sentiment significantly. Investors and tech enthusiasts alike will be on high alert for any updates, as these could provide crucial insights into the future direction of AI and its commercialization. The fallout from Google's tightening control over Android, mimicking Apple's practices, introduces a new level of uncertainty and speculation about the future of mobile OS ecosystems. This strategic pivot could have far-reaching implications, potentially altering the competitive landscape and impacting developer and consumer loyalties. The market will be watching closely for reactions from both users and developers, as well as any potential regulatory scrutiny that may ensue. Snowflake Inc.'s recent tumble, though specific to its circumstances, raises broader questions about the valuations and future prospects of cloud and data warehousing services. As companies in this sector continue to navigate the challenges of scaling and innovating amidst fierce competition and shifting market demands, we may see increased volatility in this segment. Market observers will be keenly awaiting further earnings reports and forecasts from similar companies for additional clues. Meta's strategic withdrawal from paying for news content in select markets opens up a broader dialogue on the relationship between tech platforms and content producers. This move may set a precedent for how digital platforms engage with media moving forward, potentially influencing stock performance not just for Meta, but for the sector at large. Regulatory responses to this shift will be particularly crucial to monitor. Given these turbulent undercurrents, the market in the week ahead is poised for a blend of caution and opportunism. As we've observed, the tech sector continues to be a pivotal force, driving much of the market's dynamics. Investors and analysts will be parsing through the developments of this week, using them as a lens to anticipate shifts in market sentiment and strategy. It's also pertinent to remember that external factors such as geopolitical tensions, economic data releases, and unforeseen global events have a history of abruptly shifting market trajectories. As such, while the tech sector's dramas unfold, keeping an eye on the wider world remains crucial for a holistic market outlook. In summary, the week ahead promises a mix of strategic recalibrations, potential regulatory machinations, and continued innovation, all underpinned by the ever-present specter of volatility. As always, adaptability and vigilance will be key for navigating the uncertainties of the tech-dominated markets. In a turn of events that can only be described as delightfully unusual in the world of tech stocks, Duolingo, the popular language learning and education app, found itself in the spotlight this week for an extraordinary reason. The company's stock skyrocketed by more than 30%, propelling its market cap to an impressive $10 billion. This meteoric rise was propelled by Duolingo's latest financial results, which revealed significant growth in both user base and revenue, surpassing even the loftiest expectations. The figures are indeed staggering. Duolingo reported a 65% year-over-year growth in daily active users, reaching 26.9 million, alongside a 57% increase in paid subscribers, totaling 6.6 million. The company's revenue for the fourth quarter grew by 45%, hitting $151 million. Additionally, Duolingo isn't just growing. It's also profitable, with $47.7 million in free cash flow for the same period, boasting a remarkable margin of 31.6%. The secret to Duolingo's success seems to be rooted in its engaging gamified approach to language learning, attracting a global user base eager to master new languages. With expansions into advanced English classes and mathematics aimed at children, Duolingo's encompassing strategy and incredible execution captivated investors and users alike. However, amidst the celebratory fireworks, there lays a note of caution. With the stock now trading at around 70 times its 2023 free cash flow numbers, some may wonder if the excitement has catapulted Duolingo's valuation into the stratosphere, perhaps too optimistically forecasting future growth. This raises an interesting debate on whether Duolingo's current valuation is justifiable, or if the stock's incredible leap sets unrealistic expectations for the company's financial future. As we wrap up today's show, we'd love to hear what you, our listeners, think of Duolingo's dazzling week. Is the company's stock ascent a sign of more good things to come, or are we seeing inflated expectations? Feel free to share your thoughts and comments. Let's keep the conversation going. In conclusion, today's tech market activity has been a whirlwind, showcasing the dynamic and often unpredictable nature of the industry. From Google's strategic shift towards a more controlled ecosystem to Microsoft's legal clash with Elon Musk over OpenAI, the fallout from Snowflake's financial forecast, and Meta's decision to halt payments for news content. Each story has contributed to a broad tapestry of developments that investors and tech enthusiasts will be dissecting for weeks to come. Additionally, the surprising surge in Duolingo stock adds a lighter, yet equally fascinating narrative to the day's financial discourse. These unfolding stories offer a deep dive into the ongoing transformations within the tech sector, highlighting the interplay between innovation, regulation, market forces, and corporate strategies. As we continue to navigate through these developments, the implications for investors, companies, and consumers alike are profound, suggesting a landscape that is continually evolving. We hope you found today's summary insightful and thought-provoking. If you did, please like, subscribe, and share this video with others who might appreciate a concise wrap-up of the tech market's daily happenings. Don't forget to return tomorrow for another video where we'll dive into the latest developments shaping the tech industry and its market implications. Your engagement helps us grow and continue bringing you the essential tech stock news and analysis. So until tomorrow, keep questioning, keep investing, and keep innovating.